How to understand financial PE ratios. Imagine trying to figure out if a stock is a good deal just by looking at its price. That's where the price-to-earnings ratio comes into play. It's a simple number that helps investors see how much they are paying for a company's earnings. The PE ratio compares the current stock price to the earnings per share. If a stock costs $50 and the earnings per share are $5, then the PE ratio is 10. That means investors are willing to pay $10 for every $1 the company earns. This ratio helps investors decide if a stock is overvalued or undervalued. A high PE ratio might mean the stock is expensive or that investors expect the company to grow fast in the future. A low PE ratio could mean the stock is cheap or that the company might face challenges ahead. There are two main types of PE ratios. The trailing PE uses earnings from the past 12 months, giving a snapshot of recent performance. The forward PE looks at projected earnings, which can show what investors expect the company to do in the future. Because earnings reflected how profitable a company is, the PE ratio links a company's market value with its financial health. If earnings stay steady, the PE ratio can tell you how long it would take for an investment to pay for itself through earnings. Investors often compare PE ratios within the same industry because different sectors have different typical ranges. For example, technology companies usually have higher PE ratios because investors expect rapid growth. Utilities tend to have lower ratios since their growth is slower and more stable. It's important to remember that the PE ratio has limits. Companies with no earnings or negative earnings do not have meaningful PE ratios. Also, a high PE doesn't always mean a stock is overvalued. Sometimes it shows strong future growth potential. Numbers like the PE ratio are part of a larger story about how society views value and expectations. They turn complex company performance into simple figures that guide investment choices. This shows how numbers help us interpret economic realities and understand the value of companies in everyday life.